Good morning, everyone. This is Midday Bell, where we deliver actionable insights, expert interviews, and real-time market updates to help us all invest smarter. I'm your host, Rebecca Kurzweil, and today I'm joined by Serge Berger, the steady trader. Serge has been trading since 1998 with experience in JP Morgan and in proprietary trading across equities, options, and futures. He's known for his rule-based, steady approach that helps traders cut out emotion and focus on repeatable strategies. It's so great to have you today.
Thanks, Rebecca. It's great to be here.
Nobody can introduce themselves better than themselves. So I'd love to kind of just hear a bit about you and your background, and then dive into what's catching your eye in the markets and what stocks are you trading and what right now.
Sure. Well, I've been doing this for quite some time. I think it's coming up in 26, 27 years now. And, what you learn about the markets is that they will always humble you. And so when I look at the market right now, I think there's a lot of people that haven't been humbled, maybe ever, as we've had a raging U.S. equity bull market, lower left to upper right. But, I started in this business, again, a long time ago, and then moved on over to JP Morgan on the investment banking stuff, and then onto hedge funds and family office and stuff like that. And then at some point, it just, people read the research and your thoughts really. And so I decided to, publish that, and that turned into an education thing. And we have an investment advisory firm as well, where we manage capital for our clients. So that's kind of the quick and dirty.
And you mentioned how the stock market is just an emotional, volatile space. And in a video that you just posted on your YouTube channel, you were saying how September and October tend to be some of the most volatile months in the markets. What have you been seeing, and what's on your watch list for September and October?
Yeah, I mean, it's kind of like everyone talks about it, and it's one of those things. It's a little bit like, I like to use technical analysis as one of those examples, whereas like, does it work because it actually works? Or is it because everyone's looking at the same chart and comes to the same conclusions? We will never find out, and it kind of doesn't matter. Same thing with the volatility that you tend to see in September, October. Some people, assign it to, well, people come back from late summer. Maybe, or is it just because everyone expects more volatility and becomes jumpier? So it's one of those things, but it's there. It's a U.S. equity phenomenon. Yes, the U.S. equity markets, the S&P, you can really no longer take serious. It's dictated by one stock, NVIDIA, and that's just there's not a whole lot to read in there, but I think that makes it all the more susceptible for more volatility. As long as the passive inflows and vol suppression funds basically, squeeze volatility, sell volatility, and buy stocks at the same time, the calm before the storm period can extend way longer, but traditionally we'll see some gyrations, some volatility. That's normal. That's not rocket science. You can look at any chart and you will see that in September, October. It's just the question is to what extent, and we'll find out.
And is that the S&P 500 or the Dow, or just what?
It's all, it's just U.S. equities. I mean, it'll spill over into global equities to some extent as well. When that happens, it doesn't have to be catastrophic. It's not at all, but it can be. It's one of those things you have to be, I think, staying hedged to some extent. I think one should always be hedged, but I think particularly into September, October, it pays to not have all your chips, in one corner.
And so far in 2025, hard assets like gold and silver and copper and Bitcoin have outperformed traditional financial assets. Why do you think that's happening, and do you see it continuing?
Yeah, I mean, I actually brought along a couple of charts. If you guys want to flip to that, I can show you that in a sort of matter of fact, chart first. What we like to do is we like to look at the world as the investment landscape globally. I think a lot of people are still just navel gazing at NVIDIA, and that will work until it stops working. But it's an extremely risky portfolio construction, right? If you look at this chart here, and it might be a touch light, people may have to squint a little bit. But what you can see, if you look at, for example, all the way in the upper right-hand corner, gold mining stocks are leading this year. So you're looking at a year-to-date performance of 80%. That's on a basket. Uranium is up 50%. Platinum is up 47%. The German DAX, which everyone wrote off for dead years, it goes up 33%, beating the living daylights out of the S&P and Max 7 stocks. Silver,
Yeah.
gold, that stuff, Chinese stocks, no one wants to believe that. So the portfolios, not all these assets fall in the same category, but there is one common denominator, and I can show it to you here. If I can I might have to craft a chart. Oh, no, here it is. I found the chart. So this is what explains the chart. So it's a bunch of squiggly lines. I'll keep it real simple. The line at the bottom, the blue one, that's the US dollar, right? And so when you have volatility suppression and basically financial repression and purchasing power, basically killing the purchasing power, then what you have to do is the assets that are denominated in dollars, particularly when you have still 7% deficit spending in the US, the Chinese are stimulating, Europeans are stimulating, then it's not so much that people are making a lot of money, it's just that things have gone up as the dollar's gone down. So if you're a US dollar denominated investor, then it's nice to know that your Nvidia stock's gone up, but guess what? The dollar's gotten crushed, right?
Yeah.
So, and I haven't done the math exactly on that one stock, how that stacks up versus the dollar year to date. I would expect it's probably okay. But most other asset classes are just basically on par with the dollar, meaning the money they made on whatever, being long, whatever, they probably lost being long the dollar, so the purchasing power erosion is a problem. So that explains, in my view, that other chart that I just showed you before, which is that move to, there's a lot of reasons for the hard assets rally, and we think it's just the beginning of a major 5 to 10 year run where the S&P is going to lag badly, and that's horrible for most investors, particularly in the US.
Very interesting. So is there any specific, is there any specific signals on that chart that you're watching that kind of tells you, okay, things are really changing?
Yeah, but this is just a year-to-date performance chart. I mean, if there's a lot of stuff to this. I mean, like energy and materials are our favorite sort of multi-year parts. Everyone's so gung-ho on AI. I throw up a little bit in my mouth every time I hear that. And not that there's anything wrong with AI, but there's a lot of stuff that has to go right for that to continue to go at the clip at the rate it has. Nothing goes linearly forever. There will be hiccups. But one thing that we need in order for all this AI stuff to actually happen is we need energy, and energy needs materials, right? And so again, there's a lot of ways we can twist this, but if you literally just want to look at a chart, one could look at, for example, at the chart of for example, copper. Now, copper's been a bit of
copper's talked about a lot. Yeah,
been a bit of a situation this year because it got trumped a couple of times with tariffs ons and offs. But the long term, this is just the optics, right? So people get a visual of this. If you've ever looked at a chart, you can see this is probably not too bearish. So ultimately, it's a coiled spring. Or you can look at something like uranium. These are all things we need in order to actually have energy so when all this AI hoopla can work. It's not exactly bearish, right? So it's just, again, just one piece of the puzzle, but that I think has longevity at a reasonable volatility.
Yeah, because it's been all the focus has been on the tech companies and the tech investments like S&P 500. Yeah. And so you see that maybe shifting now over the next 10 years into more like resource and energy?
Yeah, I think so. So, I mean, I just brought along literally just the breakdown of the S&P 500 sectors. And I hope it's not too small for people to see, but if we correctly add it up, technology is probably about, it's probably about 40% right now of the S&P. It's probably more because communication services is Meta. It's 10%. IT itself is 33. So it's probably north of 45%. One stock makes up 88% of the entire index. It's just not, it is what it is, but it doesn't last. So on average, the tech sector is closer to 20% of the S&P. Now, those are long-term averages. That doesn't have to change tomorrow. That's not our bet. That's not going to happen in September, October. But on long-term average, closer to 20%. Let's say we're in the Yahoo bubble age, Yahoo in terms of Yahoo, like stocks bubble age, tech bubble age. Maybe it's 22, 23% of the S&P, but not 33.
Yeah. You would
Please.
probably warn investors maybe to be cautious about investing in the S&P 500 at this point.
Well, it's a rebalancing act. People don't know what it means to manage risk anymore. We've had a
Yeah.
15-year raging bull market. You know, if you look at, I always cite this, the average age in Wall Street is about 37. You subtract 15 years, you get a college grad.
Right.
Most people in Wall Street have never seen a non-bull market.
Right.
What's worse is the average retiree
Yeah.
is about early 70s. You subtract 15 years of bull market, you get an early retiree, right?
Right.
The first time they start looking at their money, their memories are, as long as they go back, which is 15 years is just enough. 10 to 15 years is just enough to erase memory. A good friend of mine said that. I think it's very true. They cannot fathom an S&P, forget going down for
Yeah.
multiple years, sideways.
Yeah.
It's impossible. In fact, they've adjusted their lifestyles to it.
Huh.
So there's a real problem here. The good news is for investors, if they would be willing to listen, it's a simple change to make. You just have to rebalance your portfolio.
Yeah.
Because the energy sector, for example, it's about 3% of the S&P. On average, it's closer to 8% of the S&P. So that's a 2.5.
Yeah.
Material stocks are so small they don't even show up in here. It's like 1.9. It's laughable, right?
Yeah.
The funny thing is that these tiny little baby sectors are needed for all of this madness over here to take place. So so that's the constellation. I know I'm going a bit of a tangent here, but I think this is, to me, it's scary, is to say the least. Not today or tomorrow, but it's very scary if I look at it through a multi-quarter, multi-year lens.
You also described in your video that this is a momentum-driven market with trap doors beneath it. Can you explain what that means and how traders should navigate those risks?
Yeah, I mean, look, we live in a momentum-driven market, right? So we like to track momentum. Things like all these stocks, Citigroup, you can see these momentum cycles and stuff like that. The trouble is that momentum is fleeting. What I think, again, and this is very much a direct result of again, a lot of people really being very inexperienced. 10 to 15 years in this market, that would not be inexperienced if we had more than one cycle. We've had one cycle since, lower, I keep saying it, lower left to upper right. And it's a long cycle and will end probably before long. But people mistake trends from momentum because it's just gone up for 15 years, And so momentum is fleeting. So people look at a chart, and the most that they go back is maybe a couple months. Most people don't even go back that much, maybe 6 months if they, on a good day. And they will mistake what might look like a trend, but really it's just a momentum move. Right. So like, for example, you look at, I don't know, stocks like CrowdStrike, right? It's just one of them that comes to mind, and that's one of those darlings that everyone loves to talk about. Great momentum move to the upside, but momentum changes. And guess what? Since we got a momentum sell signal, this thing's down, substantially. So these are not trends. These are momentum moves. Trends are way longer. Like in our view, it's just our humble opinion. The trends in the that are just developing still in all these hard assets. Gold has a confirmed bullish trend now, but those are talking about multi-year trends. Those are trends. This stuff here is momentum. And so momentum traps change very quickly. And I'm very concerned when I hear how people talk that they're not ready to understand that momentum can shift as quickly as it can. We saw it in April, and then we had another, miraculous V-shaped recovery. But again, those momentum shifts are very fast and very sudden, and most people don't adapt to them. The average retail investor bought in April. Every single hedge fund and portfolio manager that I know of sound mind had to do some risk management in April, but the retail community has been chart chasing for 15 years because it's worked, and they got rewarded once again. The problem is when that stops working, and that's a question of time. And I don't know if it's neither my opinion nor my ability to forecast whether that's tomorrow or next week or next year. I have no clue, and it doesn't matter. It's just at some point it stops working, and then people are going to give up close to 5 to probably 10 years worth of gains over it, and not too long. That's history, right? Yeah. And I know it's a mix for a very unattractive conversation right now that people just don't want to hear from. But people don't look beyond the tip of the nose anymore because of the way the market's been over the past 15 years, and it's done very well, right? So people have actually done the right thing.
You just think it always goes up. So But one thing you mentioned in your bio too is how you help traders cut out emotion and focus on repeatable strategies. Can you, like, speaking on everything we've always spoken about, how do you do that? How do you help traders do that?
Well, I think when you're a self-directed investor or trader at home, or and a portfolio manager is different because you're working with a team. Some of them are more experienced. It tends to be global or at least national. So there's a lot of people, a lot of eyeballs. A lot of people nowadays do this stuff at home or on their phone, God forbid, and it's really them and their favorite chart that gets sent from I call them underwear traders on their Twitter accounts, and there's no repeatability in that. The repeatability is, I'm going to see what this guy says on Twitter and I'm going to buy the stock, right? That's
Yeah.
not a strategy.
No.
That's following someone who knows, right?
Yeah.
Knows maybe a lot, most likely not that much.
Yeah.
So what we try to do is show people that it's while markets are challenging,
Yeah.
repeatable strategies get people to a point where first they should get to a point where they stop losing money, which is always the first objective, right? It's like if you learn how to snowboard or something, you first want to make sure you don't catch an edge too many times, because you can only do that so many times before you're out for the season.
Yeah.
Or you know, and then you will think about making money. But unless you have the same repeatable strategy every time, here's the entry, here's the exit, here's the stop. This is from a trading perspective, right? Not an
Yeah.
investing perspective.
Of course.
And that's very possible. But most people never get to that point of repeatability, because after one or two trades that don't go the way they wish them to be, they go to the next shiny object. And that's very much, again, a symptom of the late stage gambling bubble we live in. That can continue, though.
Yeah. Yeah, I think the mistake everyone makes is buying high and selling low, basically. So having a
Inverse.
strategy,
Yeah, exactly. Buying high and selling. Oh, yeah.
So having a strategy that you stick with. I mean, that's every conversation I have, is just coming up with the rules that work for you. And I think every trader, determines that, and then just being loyal to those rules and those strategies.
Yeah, I mean, like Rebecca, if you look at this chart, right? So like you can see, like, let's take the latest signal. That's a down arrow. So that to us just means sell or buy puts or whatever, or at least get out of your longs. Like, it's important for people to risk manage. So like there's a little green dot that means profit target, right? So like this is not that difficult. The problem is most people don't do it, and they're not getting alerted when they should be doing it, and they just don't do that, period, right?
Yeah.
So it's a lot of randomness. Now, in a raging bull market, that randomness can actually work, and it has worked. Probably not to the extent that people believe it's worked for them, but it can work. It's just when things get even just a little bit more challenging, that's when this is the only thing that's going to save them from really completely blowing it up. Because it's a question of time, and it's an important for traders and investors, an important lesson to learn. Unfortunately, an expensive lesson.
So you also have a momentum trading webinar coming up. What's one core principle about momentum you want traders to understand in this kind of market?
Momentum. Actually, this is a great chart to show. So like this is actually our momentum process. So look, momentum is fleeting, as I said before. It doesn't last. It's not a trend. Trends are different. Momentum is largely driven by algorithms. So they will chase the stock higher. Like in this case, CrowdStrike, you can see the buy signal, and then it just rips higher. We've got a trailing stops, and then sell signals. And what's important about momentum is realizing that they change. They don't last forever. So don't go on vacation, right? Close it before your vacation.
Yeah.
And number two, you got to risk manage it. So our big thing is when we get a new sell signal or a buy signal, we want to make sure we close part of that position. There's a specific formula, specific percentage of that position when we reached what we call the free profit target. And it's important because we want to get to a point where we have what we call it a free trade. Meaning it's very difficult at that point to lose money. That's the objective you want to have, because people lose money for two reasons. Number one, they get in randomly, and they certainly don't take partial profits.
Right.
A lot of it is laziness, and some of it, a lot of it is greed, probably too.
Yeah.
So we talk about that in our webinar.
Greed is definitely a big one. You always think, oh, it could go higher, and just taking your profits and having, maybe a 20% profit rule, or do you have any kind of rules like that? Or
yeah, so we've got our free profit targets are volatility adjusted, so based on the stock's volatility. But yeah, we take a partial profit. Typically, we like to take half the position off at the free profit target. Mathematically, that just comes out to a point where then again, after that, it's very difficult to lose money on that trade, right? In fact, the trailing stop at that point is usually at a point where it's very likely to make money, right? So that's it's very simple risk management process. But again, people don't have the repeatability, they don't have the signal, and again, most people don't have the willingness to do that. But if you show them the results and you can show them the process, it turns out that people are able to do it very easily, actually.
And so I feel like I've taken up so much of your time today. I wanted to kind of finish up by, can you let people know how they can learn more about you and how they follow the Steady Traders or newsletter, or what kind of?
Yeah, I mean, our website is thesteadytrader.com. I think there is a ebook that we would love to make available for everybody. It's I don't know if I should type this in somewhere. It's thesteadytrader.com/top TOP.
Okay.
Do you have the ability to type that in somewhere, or should I do that somewhere?
Yeah, I'll put it in after.
Okay, so it's thesteadytrader.com/top. It's a free ebook. Basically, it's our top 3 ideas in terms of stocks right now. Not recommendations. Remember, it's always an idea.
Yeah.
But yeah, that would be a great way to get started. And
excellent. We'll include a link to that in the description to the video.
Yeah.
Amazing. Well, yeah, you've got some volatile markets that you need to probably get back to watching.
Right now, it's a bit snoozy, but we'll see what the next couple of weeks bring.
Amazing. Well, thank you so much. I really appreciate your time, and I personally learned a lot, and so I hope the viewers learn a lot as well, and then follow you online to keep up, continue to follow you and learn your strategies.
Thank you, Rebecca. Great pleasure.
Bye.